Hello class, welcome to our second lecture series on financial accounting or principles of accounting. And I'm your instructor, Dr. Jamal. Okay, so we have, up till now, we have covered the accounting equation. So what is the accounting equation? Assets is equal to liabilities plus honors equity, right? And what we discuss, honors equity, I think let me, assets is equal to liabilities plus honors equity, and honors equity is equal to retained earnings and paid-in capital. Then we talk about how we find out the retained earning for current period. So retained earning for this year or current period. Net income minus dividend. And how we find out the net income? Revenue or sales minus all expenses, right? And then we talk about the big
sorry, sir. I think I cannot see your screen. I don't know if you're sharing or it's just my problem. I don't know other.
Okay, all others, can you see?
Oh, we can see.
Yeah.
Yes.
Yes, I can see.
Can see it.
Meko, just reconnect. Okay, then we talk about, okay, the big formula for retained earning at the end, which is equal to retained earning beginning plus retained earning current.
Sir, I have a question.
Yes.
Is it possible to increase your volume when you speak, like on your computer?
Is it possible to increase my computer volume?
Yeah, because you're very, very quiet when you speak.
Okay, let me see whether I can increase my microphone so that you can,
Yes, please.
yeah, you can, hear me loud. Okay, so just because if I just, press backspace, so all this is going to wipe out. So you guys understand these formulas? So we have one formula, two formula, three formula, and four formulas. We talked about that. Okay. So let me see my microphone. Microphone access is on. And microphone.
Yes.
Okay, so our today's learning objective is number first, that we will be continuing, of course, our chapter 1. And let's talk about evaluate business operations through financial statements. So let's talk about this. So the question to evaluate the financial statements or to evaluate the business operations is going to be answered by 4 questions. Number 1, how well did the companies perform during the year? Everyone want to know that, where my company, is going through, how much we, earned during the year, what was our sales, what were our expenses. So this is going to be presented, or this is going to be shown in income statement. And what is the formula for income statement? Simple. You write down all the revenues, add them, and minus all the expenses. You will find out net income or net loss. And then when I find out that how well my company is doing, then what did the company's retained earning change during the year? How much the business retained the net income and how much it distributed as dividend. So this is going to be presented or stated in statement of retained earning. And what is the formula that we just learned in our last lecture? That beginning retained earning. If there is no beginning retained earning, this is the first year of our operations since we incept our, since the inception of our company. So there is no beginning retained earnings, so it's going to be zero. So net income minus dividend, we have ending retained earning, right? And then when we have find out how did my company doing during the year, why did the retained earning changes during the year and how much changes, we find out that okay, this much profit we kept and this much we distributed. And then what is the financial year, what is the financial position at, this is a key point, at year end, on a specific day, right now, on a specific day, what is the position of my business, how much assets I own, and we calculate it through, or we present this information in balance sheet. And balance sheet formula is assets is equal to liabilities plus owner's equity, right? And then the last one, which is very important, because the most powerful in any company is cash, and most sensitive also is cash, because cash is susceptible to fraud, changes, intentional stealing, this kind of stuff, right? Embezzlement, this kind of stuff. So we want to know that how much cash did the company generate and spend during the year, and this is only cash. So all known cash transactions, barter transactions, you are exchanging things with the things, no cash involved, that is not written here. So we call this statement of cash flows. And what is the formula? Cash flow from operations, cash flow from investment, plus cash flow from financing activities. We call this CFOs, cash flow from operations, CFI, cash flow from investment, CFF, cash flow from financing, or operating cash flow, investing cash flow, financing cash flow. We'll talk about this one by one, every detail of these statements and how we are going to present it. Simple. So we have seen how questions going to be answered, and this is a kind of data that flows, to evaluate the business. First, you need to evaluate how well your business is doing, and then how much you distributed, and then what is your financial position, and at the end, how much cash you distributed during the year. Simple. So it means first, so this is a hierarchy. So there is an order, chronological order in making the statement. Number one, you need to make income statement. What is the formula for income statement? Revenue minus all expenses. Statement of retained earning, what is the formula? Retained earning at the beginning plus net income, current year net income, okay, minus all expenses. Sorry, net income minus dividend. We call this retained earning at the end. And when we find out this one, then we make balance sheet. What is the formula for balance sheet? Assets is equal to liabilities plus owner's equity. If you cannot remember this hierarchy, then simple, understand that you need to find out first the income from income statement, and that income statement is going to be used here. Without this year income, you cannot make the statement of retained earnings. And when you find out the retained earnings, what is the formula for owner's equity? Paid in capital plus retained earnings. So this value is going to be, just we put the figure from retained earnings statement and put it here. So you can also remember that one. Okay, first we need to make income, retained earning, balance sheet, and at the end we're going to find out what happened to the cash. Cash, only cash which actually go out from your pocket and coming into your pocket or in your banks or whatsoever, right? Not the barter transaction, not the non-cash transaction. We'll talk about what do we mean by this non-cash stuff, right? Like,
Sorry to interrupt, but I think before it was better. Right now it's there's too much noise and a high audio.
Oliver, then you need to increase your volume.
I mean, yes, before it was a little bit quiet, but I think quiet is better than now because it's extra loud.
Okay, let me adjust the settings and you need to tell me that whether. Okay, I hope I fixed the volume issue, the microphone issue. Okay, now, so everybody understand this hierarchy here or this order here? First, we need to make income statement, then the statement of retained earning or retained earning statement, and then balance sheet, and then fourth one is this statement of cash flow, right? And then we have a link here as well. So now let's start. What do we mean by the income statement and how we can measure the performance of the or evaluate the operations of the business? Number one, income statement. It is also called statement of operations. So what is the biggest operation of a company? Sell goods, manufacture goods, and sell goods. Buying raw material, converting them into finished goods, and then sell it to the market, right? So all these information we are going to summarize in income statement, which is also called statement of operations. So first of all, we need to report revenues and gains. What are the gains? Gains mean, which is, seldom we do this kind of transaction. For example, old furniture is replaced with the new furniture. So old furniture is sold. So we have some kind of gain. Old vehicles are sold, old building is sold, right? So these are not daily, day-to-day transaction of the business. Revenues include day-to-day operations, buying, selling. So if a company is a furniture company, then its revenue is selling furniture, or that furniture which it is using for its office use, and if that is sold, that is not sales. That is, if you receive some extra money, if you sell it on profit, then we call this gains. Or if a company has extra money, it invests in stock market, receives some dividends, some interest income, or if buy share for a short period of time and sell it on higher price, we have a gain. We call this gain. So these are not day-to-day transactions, right? Expenses and losses, similarly, losses is opposite to the gains. Expenses that are day-to-day transaction which helps to increase this sale. So that salaries we pay because workers are working to make the product. We pay the bills, right? Utility bills, water charges, whatsoever. We all call these expenses. So the bottom line is, which is revenue minus expense is equal to income or net loss if it's a negative sign, right? So how we are going to write down in statement form? So this is a statement, not a formula or not an equation. Equation is simple. Revenue minus